Welcome back to Financial Tea with Damilola Gbadamose, where we learn simple ways of investing and how to put your money to work. On today's episode, we'll be talking about what every beginner should know before investing, and that is risk versus reward. If someone offers you 200% return on your investment with zero risk, please run. Please run, because such investment hardly come without risk. So today we're learning what exactly is risk versus return. It's a red flag. Even your savings that we say is safe is not without risk, because like we have explained before, if you're not getting return for your money in terms of maybe inflation is higher than the interest they're paying you on your savings, that's risk. You're not getting as much return for your risk. So there's hardly any investment that comes with zero risk. So that's why we'll be breaking it down for you, just to help you guide how you save and invest wisely. What is risk? Risk is the possibility of losing money. That is risk. And you could lose all your money, you could lose some, you could lose 50% of your money. And that is just what risk is defined. So then, what is returns? Returns are what you get back from your investment. So you can say, for example, your rental income, your dividend, your coupon payment, and your capital gains. Those are what we call return. So risk versus return. How do they weigh? The riskier your investment, the more your return should be. And the lower your risk, the lower your return. So like we've been saying, treasury bills, they have low risk and low returns. Equity, they have higher risk, higher return. Equity is also stocks or shares, whichever you like to call it. So the higher the risk, the higher your return. So equity is high risk and you get higher return. Your capital gains, your dividend payment, sometimes the share price can move from 2 naira to 5 naira. Sometimes it can move from 20 naira to 35 naira. So that is increase. So that's why you say the higher your risk, the higher your return. And then cryptocurrencies, topic I'm not diving into yet, but just for this example, you know the way crypto moves and you also know the way it comes down. So that's why we say the higher your risk, the higher your return. Cryptocurrency, by all these our examples, seems to be the riskiest for now, based on knowledge gap and a lot of other issues surrounding it. So the higher your risk, the higher your reward. The key is to balance it. So you don't put all your investment into risky investment, and you don't put everything into the safest of the safest. And like we said, your risk appetite should determine how you are going to weigh it. So am I going to put 20% in risky investment and leave 80% in safer investment? Am I going to put 50-50? Am I going to put 30-30? Ensure you diversify based on your risk appetite. You can decide, am I going to put 10% in risky investment and 90% in safe investment? Or am I going to wait 40-60? Or you want to wait 50-50? Or you're the very risky type and you want to put 80% in risky investment or 20% in safe investment? It all depends on you, your risk appetite, your time horizon, and your goal. Remember that in our last lecture. So you need to be able to balance. Today's topic, like we said, is about your risk return and how you're going to diversify that. So please ensure that your investments are diversified. Ensure that your investments are what? Diversified. We say it often, do not put your eggs in one basket. You need to have some form of risky investment, but the percentage, you decide by yourself. Are you bold enough to invest in cryptocurrencies? Are you bold enough to take on the equity market or the stock market? Are you bold enough to take on real estate? It depends on you. So diversify your investments. Diversify your investments. That's all today on Financial Tea with Damilola. I hope you have enjoyed today's topic. I will implore you to please click the like button. Yes, subscribe and share to your friends, and then we'll talk more financial teas. We'll start juicing what is in the market once I know that everybody knows what I'm about to be saying. When I say, oh, the market is bullish, oh, the market is bearish, oh, the bears are in the market today, oh, it was the doves that were in the market, oh, what is Fed going to say, what is Jackson Hole. I know you want to learn more of that, and I'll share more of those teas with you. But let's get there gradually. Let's take it beginner, little